Imagine taking a $59 billion tech giant, right? And just voluntarily erasing almost half of its account of value in a single quarter.
Right.
While, carrying this staggering $39 billion in debt. And then the stock market turns around and rewards you with a 14% rally.
Yeah, it's wild.
It's completely wild. So today we are looking at this, well, basically financial alchemy that Salesforce is pulling off in late August 2026.
It's an incredible paradox to look at, honestly. You glance at the surface level balance sheet, and frankly, it looks terrifying.
Oh, absolutely terrifying.
Right. But then you look at the stock chart, and the market is just cheering them on.
Yeah.
So our mission today is to really look under the hood of this massive new equity research report and, figure out how they're managing this high wire act.
Yeah.
Like, is this the start of a legitimate AI-driven renaissance for a mature software company? Or is it just this masterclass in financial engineering that's designed to kind of mask a slowing core business?
Right, because we are definitely going to get into the mechanics of that financial engineering because it is, well, it's brilliant. But before we do, the catalyst that set this entire narrative in motion was their Q2 fiscal year 2027 earnings report, which literally just dropped on August 26th.
Yeah, it just came out.
And the top line revenue, it beat expectations, right? It came in at $11.35 billion for the quarter. But I mean, revenue beats happen all the time.
Sure they do.
That is not what caused the whiplash in the stock price. The absolute jaw dropper in this research was the forward guidance.
Right, they've got
because Wall Street analysts had this consensus estimate that Salesforce would generate about $14.14 in earnings per share for the full year. And then management comes out and essentially says, no, we are going to make almost $17.
Yeah, to be exact, they raised that adjusted EPS guidance to a range of $16.67 to $16.71.
Which is just a massive jump.
It's huge.
Yeah.
In the world of mature enterprise software, finding a 20% surprise in your couch cushions is just virtually unheard of.
Right.
That magnitude of a beat, it forces institutional investors to basically immediately reevaluate how they're pricing the entire company.
And the pricing context is so critical here, I think, because going into this earnings print, the stock had been just battered. Over the trailing 52 weeks, it was down 17%. It was sitting, I think, 23.6% below its high of $269.11.
Exactly.
So the market had them trading at a price-to-earnings multiple of around 19.9x. Which, for a tech giant that essentially owns the software plumbing for global corporate sales departments, 19.9x just feels incredibly cheap.
Right. It's a value multiple almost.
Yeah. You have this company generating double-digit trailing revenue growth, about 11%, and pulling in gross margins of over 77%. So when they drop a massive earnings per share raise on top of a 77% gross margin, that 19x multiple suddenly looks like this glaring mispricing. It's like it's like a heavyweight boxer who is just down on the mat looking totally knocked out, and then suddenly they just land this massive combo.
That's a great way to put it.
So I guess my question is, okay, let's unpack this. Is this 14% recent rally just a dead cat bounce, or is this the start of a real comeback?
Well, what's fascinating here is that the market realized it had priced Salesforce like this legacy dinosaur, right? Like their hyper growth days were just permanently in the rearview mirror.
Yeah.
So that 14% rally we've seen over the last few weeks is basically the sound of funds scrambling to get their positioning right.
Yeah.
But it begs a massive question.
Which is?
You don't magically conjure a multi-dollar EPS jump out of thin air just by, tweaking your sales software a little bit.
No, you definitely don't.
Right. So you either have a totally new engine for growth or you are pulling some very heavy financial levers behind the scenes.
And it seems like it's a bit of both, honestly. I mean, selling a new narrative explains the stock bump, but the research points to a very real monetization engine they are aggressively revving up, which is obviously artificial intelligence.
Of course.
They are attacking the AI space from two distinct angles. The first is their internal offering, which they call Agent Force. And the second is this massive new partnership with Anthropic, which they have branded Claude Force.
Claude Force.
Yeah, quite the name. But let's start with Agent Force, because the report cites it as a key catalyst for the quarter, specifically noting it drove 14% year-over-year CRPO growth. Now look, I hate jargon. For the normal person listening, what on earth is CRPO and why should they actually care about it being at 14%?
So CRPO stands for Current Remaining Performance Obligation, and it is arguably the most important metric for a software company because it strips away all the marketing fluff and shows you the actual immediate financial reality.
So think of CRPO kind of like a subscription box company, right? Let's say I run a business sending out monthly coffee boxes.
Okay, I like coffee.
Right, so I have a warehouse full of guaranteed signed orders for the next 12 months. I haven't shipped the boxes yet, and I haven't technically earned the money yet, but I know exactly how many boxes I am legally contracted to pack.
Yeah.
Is that basically CRPO? It's the sum of all the money customers are legally bound to pay you over the next year that you just haven't billed yet.
That analogy is spot on. It's exactly that because it highlights the certainty of the revenue. It's essentially a crystal ball for unbilled future revenue.
Right, it's locked in.
Exactly. When Salesforce says their CRPO grew by 14% year over year, and they attribute that specific momentum to Agentforce, it proves a really vital point to Wall Street.
That people are actually buying it.
Right. It proves that enterprise customers aren't just, kicking the tires on AI. They aren't just running free pilots to see if it's cool. They're signing binding contracts. The money is locked in the pipeline, which validates the narrative that AI is an actual monetizable product for them, not just some earnings call buzzword.
Which brings us to the second angle, right? Claude Force, which, again, the name, but teaming up with Anthropic is a really fascinating strategic pivot because historically, major tech companies, they have this innate desire to build everything in-house so they can own the entire stack.
Oh, absolutely. The ego in tech is huge.
Exactly. But building a frontier foundational language model today is a multi-billion-dollar arms race.
And it's an arms race Salesforce, frankly, doesn't need to win to be successful.
No.
By partnering with Anthropic, who, they build the Claude models and are widely considered one of the absolute premier AI labs in the world right now, Salesforce gets instant credibility.
Right.
They don't have to spend 2 years convincing chief information officers that their proprietary in-house AI is just as smart as the state-of-the-art models.
Because it is the state of the art.
Exactly. They simply plug into the state of the art.
And it creates this massive gravity, well, for corporate data. Because think about it, if I am a Fortune 500 company, decades of my customer data, my sales pipelines, my internal communications, they are already locked inside Salesforce's servers.
Yep. They own your data.
Right. So by plugging a frontier model like Claude directly into that specific proprietary data, the AI becomes infinitely more useful than just, a generic standalone chatbot on a website. It can actually understand the specific context of my business, and competitors can't easily replicate that because they just don't have that same historical footprint of enterprise data.
And that makes the Salesforce ecosystem incredibly sticky.
Yeah.
Once you have these autonomous AI agents seamlessly executing workflows based on your proprietary data, the friction required to rip out Salesforce and move to a competitor becomes astronomically high. You'd lose all that automation.
Okay, so the AI strategy explains the top-line growth and the pipeline momentum. But growing revenue is great, except you can't get an almost 37% jump in Q1 net income, hitting over $2.1 billion from just a 13% increase in sales.
No, the math doesn't work.
The math totally doesn't work. You only get that kind of bottom line explosion by ruthlessly cutting what it costs to run the business and, manipulating the actual share count. So let's look at the financial engine room, starting with their margins and their capital expenditures.
Yeah, this is where we see the sheer power of operating leverage in a mature software platform. Because the core product is essentially just code, right? So the marginal cost of delivering that software to the next 10,000 customers is incredibly low.
Right. It costs them nothing to copy and paste the code.
Exactly. We already noted their gross margins are pushing 78%. But what really stands out in the research is the recent capital discipline.
Yeah, the CapEx was crazy low.
It really was. Capital expenditures, so the physical cash spent on servers, real estate, hard assets, it dropped down to just $145 million in Q1.
Wow.
For a massive enterprise generating over $11 billion in quarterly sales, spending only $145 million on physical overhead is remarkably light.
It's basically nothing.
Right. So almost all of that gross profit is flowing completely unimpeded down to the bottom line.
But let's look at the actual financial engineering, because this is where I had a huge aha moment reading this entire research report. I was looking at their balance sheet, And I noticed something wild. Here's where it gets really interesting. Stockholders' equity plummeted.
Yo.
It went from $59.1 billion down to $34.2 billion in a single quarter. To a normal person, seeing $25 billion of accounting value evaporate looks like an absolute disaster. It sounds terrifying. Did they just lose it in the couch cushions?
No, they didn't lose it. I mean, it looks alarming on paper, but it's entirely by design. To a Wall Street analyst, that drop is just the mechanical footprint of their massive $25 billion share buyback program,
Okay.
which is finalizing in October 2026. They're artificially shrinking the denominator on purpose.
Right.
It is an aggressive, highly effective maneuver. When a company takes its excess cash and buys its own shares from the open market, those shares are permanently retired.
They just disappear.
Right. From an accounting perspective, that cash leaves the asset side of the balance sheet. And to balance the books, it reduces stockholders' equity.
Let's actually walk through the math on this because it explains that massive earnings per share guidance raise that just shocked the market.
Sure.
Let's say a hypothetical company makes $100 in pure profit and they have exactly 100 shares of stock floating around. That means they have an earnings per share of $1.
Simple enough.
Right. Now imagine they take their cash, buy back 50 of those shares, and just burn them. The company still only makes $100 in profit. The business itself didn't get any better. But that same profit is now divided by only 50 shares. Boom, your earnings per share just doubled to $2. The underlying business didn't get any more profitable, but the primary metric Wall Street obsesses over just skyrocketed.
And if we connect this to the bigger picture, that is exactly how buybacks act as an artificial floor for a stock. It is a financial shock absorber.
Okay.
If their core customer relationship management software sales start to naturally slow down because the market is just saturated, the buyback guarantees that the earnings per share will continue to look incredibly robust.
Right, because there are fewer shares.
Yes. It amplifies the earnings even if the fundamental core CRM software sales are maturing.
It is a brilliant financial maneuver, but, I mean, it is not free. You can't just burn $25 billion in cash without consequences. Which brings us to the elephant in the room. The massive $39.28 billion anchor currently tied to their ankle.
Right, the non-current long-term debt. It is a staggering amount of leverage for a software company, and it completely changes their risk profile. Much of that debt is a hangover from their history of aggressive, really large-scale mergers and acquisitions.
And the report specifically flags their ongoing integration of Informatica as a major execution risk.
Yeah, that's a big one.
Let's actually define what Informatica does, because it sounds incredibly dry, but it is so vital to understanding the danger here. They handle enterprise data integration. They build the underlying pipes that allow massive, completely different corporate databases to actually talk to each other. Strategically, I totally see why Salesforce wants them. They don't just want to be the dashboard you look at. They want to own the actual plumbing underneath.
They want to be the whole house. But integrating data plumbing at an enterprise scale is a notorious nightmare.
Oh, I bet.
Historically, tech M&A at this scale is fraught with disaster. You have these deeply entrenched technology stacks that simply refuse to integrate cleanly. You have aggressive culture clashes between engineering teams. And most dangerously, if the integration disrupts the service, you risk alienating the very enterprise customers you just paid billions of dollars to acquire.
And when you were sitting on $39 billion in debt, you basically have zero margin for error.
None.
If the Informatica integration requires massive, unexpected cash outlays to fix, I don't know, technical debt, or if it causes customer churn, that leverage suddenly becomes a suffocation hazard. They don't have the financial flexibility to just absorb a multi-billion-dollar mistake.
Which is exactly why the market is paying very close attention to how they're reporting their earnings. Specifically, the divergence between their GAAP and non-GAAP numbers.
Okay, this was the biggest red flag in the entire report for me. We talked earlier about how they completely crushed their adjusted earnings guidance, right? But the research points out that their Q3 GAAP, guidance gap being generally accepted accounting principles, the strict, legally mandated accounting rules actually missed analyst estimates.
Right.
They guided for a GAAP EPS of $1.81 to $1.83, which fell short of the $1.90 Wall Street target. Wait, so they missed on GAAP guidance but beat on adjusted. Are they just moving the goalposts to make the numbers look pretty?
It's a completely valid skepticism. I mean, it is one of the classic tension points in equity analysis. Adjusted earnings, which are often called non-GAAP earnings, are where management gets to strip out expenses they deem one-time or non-operational.
Right.
And sometimes this is completely fair. If a company has a literal factory burned down, you back that out so investors can see how the actual core software business is performing. But the danger arises when the gap between the strict GAAP reality and the adjusted narrative becomes persistent and wide.
Because it is usually masking things that aren't actually one-time events at all, right?
Precisely. In the tech sector, persistent gaps between GAAP and adjusted earnings can mask a lot of sins. They're almost always used to obscure two things: ongoing bleeding integration costs from acquisitions like Informatica and heavy stock-based compensation.
Oh man, that stock-based compensation dynamic is wild when you actually pair it with the buyback. So let me get this straight. They pay their developers and executives in stock, which dilutes the shares and hurts the everyday investors.
Right.
Then they take the company's cash and do a massive buyback to artificially reduce the share count and fix the dilution they just caused.
Yep.
And finally, they back the expense of that stock compensation out of their adjusted earnings, so it looks like it didn't cost the company anything at all. It is literally circular financial logic. It's quite the loop. And that is exactly why that Q3 GAAP guidance miss is so critical. If the GAAP earnings, the actual strict accounting reality that includes all those costs, start consistently missing expectations, the market will eventually stop trusting the rosy adjusted narrative. The buyback engine can only mask fundamental margin deterioration for so long.
So we have these two massive opposing forces basically colliding here. On one side of the ledger, you have incredible AI pipeline momentum with Agentforce, the brilliant strategic partnership with Anthropic, and this $25 billion buyback engine supercharging the EPS.
Right.
But on the other side, you have a $39 billion debt anchor, a highly complex and hairless integration with Informatica, and this troubling divergence in the accounting metrics. Weighing those two futures against each other, where does the ship actually sail over the next 2 to 5 years? The research lays out a blue sky scenario and a thesis breaker scenario. Let's start with the bull case. Sure. In the blue sky scenario, the AI pivot just executes flawlessly. Agentforce doesn't just get pilot programs, it scales massively across Fortune 500 companies. Enterprises adopt these autonomous agents across their sales and service departments, driving that CRPO metric even higher.
Right.
Simultaneously, the Informatica integration goes smoothly, creating this unified, frictionless data platform without causing any margin disruption.
Hold on. Even if the AI works perfectly, I have to challenge this blue sky scenario regarding the balance sheet.
Okay, go for it.
You are painting a picture where they just casually manage a $39 billion debt load. But if their core CRM business is naturally stalling, because let's be honest, everyone on Earth who needs CRM software probably already has one, aren't they relying entirely on an unproven AI product to bail out that massive debt? That feels incredibly fragile for a company of this size.
Your skepticism hits on the exact mechanism they need to pull this off, which is free cash flow. We mentioned their incredibly light capital expenditures earlier because they aren't building physical infrastructure. Their proxy for free cash flow in Q1 alone was roughly $6.56 billion.
Wow, just in one quarter.
Exactly. That is a gargantuan cash-generating engine. In the blue sky scenario, the AI revenue stabilizes the top line, and they use that massive free cash flow to systematically, aggressively pay down the debt.
Okay, I see.
As the debt load shrinks, their interest expense plummets, which naturally improves those strict GAAP earnings we were just worrying about. If they pull that off, the market stops viewing them as a legacy software company and fully re-rates them as a premium AI platform, potentially pushing the stock well past its previous peak of $269.
But if they stumble, we hit the thesis breaker scenario, the dark timeline.
All right. In the thesis breaker, the Informatica integration becomes a classic M&A quagmire. Tech stacks clash, costs spiral out of control, and management gets entirely distracted, putting out internal fires. Meanwhile, the core CRM software growth continues its natural deceleration, and the fatal blow. The AI tools fail to monetize durably.
Meaning customers sign up for Agentforce for 12 months, run the numbers, realize the AI agents aren't actually saving them enough money to justify the premium price tag, and they just cancel the contracts.
Exactly. To summarize, the entire bullish thesis right now hinges on one very specific metric: whether Agentforce and Claudeforce adoption translates into sustained revenue.
Not just a fad.
Right. It cannot just be a one-quarter blip driven by enterprise fear of missing out on AI.
Yeah.
If the AI revenue evaporates and fails to offset the slowing core business, that $39 billion debt load suddenly becomes suffocating.
So for the listener trying to track this narrative in real time, the research outlines 3 specific watch points to monitor over the coming months to see which of these 2 scenarios is actually playing out. The first, and honestly most immediate hurdle, is the Q3 FY 2027 earnings report, which is expected in late November 2026. The market will be watching like a hawk to see if they actually hit that newly raised $16.70 EPS guidance bar. If you artificially raise expectations that high and then miss, Wall Street will be merciless.
Oh, without a doubt. And the second critical watch point is the AI adoption metrics. We need to see if that 14% CRPO growth holds steady or, better yet, accelerates. We need concrete proof that the Anthropic partnership is actually driving new pipeline and not just generating good press releases.
And the third watch point is the Informatica integration. We need to look for any signs of friction, unexpected write-downs, sudden margin pressure, or, executive turnover in that specific division.
Right.
Any of those are leading indicators that the data plumbing isn't connecting the way they promised.
Yeah, to summarize this entire inflection point, Salesforce engineered a massive rally on August 26th through a combination of legitimate AI promise and sheer financial force. The $25 billion buyback is a really powerful tool to protect their earnings per share, but the path forward is a high-wire act. They have to balance a heavy debt load and a complex acquisition against the ultimate test, which is proving that AI can generate real, lasting revenue.
It is a brilliant, high-stakes transition.
It really is. But as we wrap up this deep dive, there is one final provocative thought that emerges when you look at the long-term implications of their strategy.
Oh, what's that?
Well, we spent this entire time talking about Agentforce, creating these highly autonomous AI agents that can literally do the work of human employees, right? Handling customer service inquiries, doing outbound sales, writing emails.
Right. That is the ultimate pitch of the Anthropic partnership, outsourcing all the busy work to Claude.
Exactly.
Yeah.
But think about the underlying business model of Salesforce for the last 2 decades. It is a subscription model based fundamentally on the number of seats. You pay a monthly fee per human user logged into the system.
Right.
This raises a massive, almost existential question. If their AI is incredibly successful, and one human manager armed with an AI agent can comfortably do the work of 3 human sales reps, doesn't that inherently mean companies will eventually need to buy fewer human software seats?
Oh, wow. Wait, really? So by building the ultimate productivity tool, they might actually be eliminating their own paying customers.
Could Salesforce's ultimate triumph in AI eventually cannibalize its own traditional per-user subscription model? It is a fascinating paradox that could completely upend their fundamental revenue structure over the next 5 years. And frankly, looking at the recent rally, it's a risk the market hasn't fully priced in yet.
Definitely something to chew on until the next quarter's numbers drop. That's a great point to leave it on.